so basically, if you're looking at it, it's a 25% gain in August. The last time Apollo rallied, so it's been a marked underperformer, no doubt. The last time Apollo gained, the last time it gained was 33%, and that was in 2009. So it's been almost 9 years since you saw such a big rally that came in Apollo Hospital. So obviously a big rally that's come in on Apollo Tyres. And as Somit was saying, Reliance is expensive. Still on an EV to EBITDA basis, Apollo is one of the cheapest hospitals that we have in India. So despite the rally, Apollo continues to be cheaper than some of its peers. Now, what's exactly happening? Look at the revenues. Now, if you're looking at the revenues over the past 5 quarters, from a 1600 crore revenue, it's gone all the way to 1900 crores. Now, the difference here is that, even though they were growing on the top line, that was not coming as far as the bottom line or the margins were concerned. And if you see the profits and if you see the EBITDA and the EBITDA margins, you can come to so. So the EBITDA has grown from 170 crores to 227 crores, but it's been in this range only. Similar is the case as far as the margins are concerned, 10% to 11.9%, and it has grown. And the fourth quarter was a big turnaround. And even if you're looking at the profit over the past few quarters, it's managed to stay. In fact, it's come down from the highs that we saw, but on a year-on-year basis, there's a massive jump. So what this is saying is the fact that revenues have grown significantly. There are severe amount of cost problems that are there, cost overruns, and the high debt and the finance cost and the high capex cost, and that is not helping them grow on an operational basis. Now, what has happened is the first quarter was a strong quarter, but the management commentary was very strong, and that gave rise to this rally. First of all, the management in the first quarter now said that the focus will now be on profitability over capex this time around, and that is something that turned around for Apollo because they were doing heavy capex. There was a turnaround that was seen in all the verticals for Apollo this time around. Growth was seen, be it the hospital business, be it the pharmacy business, all of them did extremely well. The other factor is the fact that, only 2 of the 15 new hospitals now are EBITDA loss making. And so that's been a big turnaround. And the Navi Mumbai hospital that they have actually broke even in June. So basically, they're doing extremely well as far as their new hospitals are concerned. And these new hospitals are the ones that have a lower margin. That will improve. They have access. The new hospital in Lucknow will give them access to the north and east markets. And that pretty much will be the new growth trigger for Apollo hospitals going ahead. The pharmacy business, which they wanted to sell for a long time and haven't been able to do that has been extremely strong. The numbers came out strong. The performance was good. The volume growth was good this time around. And losses in Apollo Health and Lifestyle, even though this is a very small part of the business, but losses have actually narrowed significantly. And over the next few quarters, the management has said that even this business will break even for Apollo hospitals this time. Apart from it, what are the future growth triggers for Apollo going ahead? Increased capacity as new hospitals. Basically, the old hospitals are anyway doing well. The lower margins is coming in because of lower capacity at the newer hospitals. That will improve now because all of them have managed to break even. Apollo Health and Lifestyle to break even in FY20, which is what the management has said, which is basically loss making, and that will do for the company. They've said that they will focus now on cost control as far as consumables as well as manpower is concerned. And remember, this was what was causing the problem on the EBITDA, because if you saw the numbers that came out, even on a year-on-year basis, the numbers grew over the past 3-4 quarters because of increased cost, because of increased capex, and because of increased debt. They were not able to get the operational number. And finally, debt reduction is something that will happen. Most of their capex is actually over, and they will now be able to generate a lot of cash flows that will help them in reducing debt for the company. As far as the risk is concerned, regulatory issues remain a big issue in terms of price cap, and that was something that was keeping hospital stocks much lower. But remember, there's an opportunity here also because of the launch of the Ayushman Bharat scheme, and Apollo over the weekend has said that it will be part of it. A lot on the street are now saying that because of certain schemes of the government that they have come out with and they're joining it, price caps probably won't come in, and the excess regulation by the government won't come in on the hospital stocks. So this is about it. As far as valuations are concerned, not the most expensive, 20 times on EV to EBITDA basis. FY20 is 16 times. It is still almost 9 to 10% cheaper than your Narayan Judale or even your Fortis Healthcare. So valuation wise, it's must run on cheaper basis on an EV to EBITDA basis. Brokerages love this stock. If you're looking at it, 23 companies cover, 23 analysts cover it. 21 have a buy, 2 have a hold, and none of them sell. And if you're looking at it, this trend, initially there were a lot of sell calls on that, and that has actually reduced significantly. Even after the rally, there is a potential of 14% increase that the Bloomberg consensus estimate does show on Apollo Hospitals.